Hello everyone, this is Victor here. Welcome to the Intelligent Investor channel. In today's video, I'm going to talk about JD stock analysis. Recently, many subscribers asked me to make an updated video about JD stock because there was a large sell-off of high-growth tech stocks in the past 1 month in March this year. And JD stock did drop as much as 20% in the past 1 month. Also, many other high-growth tech stocks dropped as much as 10% to 20% or even more because the 10-year US Treasury yield suddenly jumped above 1.7%. What is happening right now is that many investors are concerned that higher inflation rates as well as the US Treasury yield will continue to impact all growth stocks going forward. In this video, I'm going to give you an updated stock analysis of JD.com. First, I'm going to talk about the biggest key takeaways from JD's most recent Q4 2020 earnings release. Then I will talk about JD's long-term growth prospects. Then afterward, I'm going to talk about JD's 3 major risks ahead. Before the end of the video, I'm going to show you how I calculate JD's intrinsic value. Then we can compare JD's intrinsic value with its current stock price. Then we can know whether JD stock is undervalued right now. And at the end of the video, I'm going to show you my price target for JD stock. If you like this video, remember to hit the like button, subscribe, and turn on the notification button. I will continue to make many great stock analysis and market commentary videos every week that will help you become a great investor. Well, let's start. The first thing I want to talk about is JD's most recent Q4 2020 earnings release. JD did very well in Q4 2020. JD hit 472 million annual active customers for the 12 months ended on December 31st, 2020. Pinduoduo hit 788 million annual active customers. Alibaba hit 779 million annual active customers. What this means is that JD is now the 3rd largest e-commerce company in China by annual active customers. JD's management said this: we continue to see exciting user growth in the lower tier cities, which contributed over 80% of our new users for the first time in Q4 2020. Right now, lower tier cities have the highest user growth opportunities in China. JD's net product revenues grew 28% year over year in Q4 2020. JD's net service revenues grew 53% year over year in Q4 2020. JD's operating margin remains very low at 1.5% in Q4 2020. Because JD buys its own products and inventories from suppliers like a retail store, then JD sells its products to customers directly. Alibaba, JD's biggest competitor, does not own its own products and inventory. This is why Alibaba's gross margin and operating margin are much higher than JD's. But the good thing about JD is that JD has very strong operating cash flow and free cash flow growth. For example, JD's operating cash flow grew at a CAGR of 28% each year between 2015 and 2020. JD's free cash flow grew at a CAGR of 37.5% each year between 2015 and 2020. When it comes to analyzing stocks and investing, it's very important to be forward-looking instead of backward-looking. So let's talk about JD's long-term growth prospects. The first thing I like about JD's business is e-commerce business in China. As of now, China has the largest e-commerce market in the world. China also has the most internet users in the world, with almost 1 billion internet users in China by the end of 2020. China has the largest 1.44 billion population in the world. eMarketer predicted that e-commerce will account for more than 50% of total retail sales in China in 2021. This is first time in history, up from 44.8% in 2020. E-commerce in China is dominated by the big 3, Alibaba, JD.com, and Pinduoduo. eMarketer predicts that Alibaba will have approximately 50.8% e-commerce market share, while JD will have around 15.9% and Pinduoduo will have around 13.2% this year. Now, more consumers will continue to shop online more than ever using the top 3 e-commerce platforms in China. JD is the largest online retail store in China. This is why I believe JD will continue to benefit from more consumers shopping online in China. JD's business model is very similar to Amazon's business model in the US. JD runs a business to consumer B2C business model. This means JD has to source its own products and sells directly to customers online. JD also has the most reliable and best logistics network in China. I'm going to talk about JD's logistics business later on in this video. JD is also expanding to lower tier cities in China to build its own group purchase business to compete with Pinduoduo's business directly. JD is expanding more to marketplace to allow third-party merchants to sell on JD and to use JD's logistics network. Personally, I believe JD's biggest competitive advantage is its JD Logistics business and its supply chain technologies. This is from JD's latest Q4 2020 earnings release. Now, JD has over 900 national warehouses and fulfillment centers across China. This is very similar to Amazon in the US. Now, JD's 900 warehouses cover pretty much most areas in China. JD also has more than 7 million SKUs of direct sell products in over 900 warehouses across China. Here's JD's biggest competitive advantage. JD's logistics network delivers around 90% of orders within the same day or next day. As far as I know, JD's logistics business or JD's logistics network is the best in China right now, even compared with Alibaba's Cainiao logistics network. Now, many people choose to buy from JD instead of Alibaba because of JD's fastest delivery in China in most cases. JD tends to have high quality products. So why is this the case? This is because JD's online retail store has to buy its own inventory from suppliers before selling its own products to customers. JD has to ensure all of its products have high quality before buying them in large quantities from suppliers. So if you compare JD's business model with Alibaba's business model, Alibaba is only a marketplace. Alibaba does not own or source its own products. But the good thing about Alibaba's business model is that Alibaba's gross margin and operating margin are way higher than JD's. Another thing is that JD's management is continually investing more capital to expand its fulfillment network, improving its supply chain technologies, and now JD's logistics business is offering its logistics services to third-party sellers and merchants, which is similar to Amazon. This is from the Wall Street Journal. JD Logistics also represents how JD sets itself apart from its biggest rival, Alibaba. JD has long spent heavily on its own logistics network, unlike Alibaba, which acts as a marketplace for merchants and outsources its delivery to third-party courier companies. JD's more reliable and timely delivery shown during the COVID-19 pandemic. JD Logistics said about 90% of the orders it processed for its parent last year were delivered on the same day or the day after. JD Logistics has started serving external customers in recent years, as well as merchants selling on JD's online marketplace. Its parent still accounts for more than half of its revenues, but revenue from external customers is growing much faster. Here's the important part you want to know. JD is planning to spin off JD Logistics to a separate public company to be listed on the Hong Kong Stock Exchange. JD's management said this. On February 16, 2021, JD Logistics submitted a listing application form to apply for the listing of its shares on the main board of Hong Kong Stock Exchange. Please note that there is no guarantee as to whether and when the proposed listing will take place. According to South China Morning Post, once the spin-off is complete, JD.com will continue to indirectly hold more than 50% of shareholdings in JD Logistics, and therefore, JD Logistics will remain a subsidiary of the company. It currently owns 79.12% of JD Logistics. Now, I believe spinning off JD Logistics may unlock more values for JD.com going forward, as long as JD will still own a substantial share, let's say 50% or more in JD Logistics. In terms of risk, the first major risk is the higher inflation rate risk right now, as well as the higher 10-year US Treasury yield right now. Right now, at the time of making this video, the 10-year US Treasury yield is just above 1.7%, which is an all-time high in the past 12 months. Now, many investors are afraid that inflation rate will be much higher going forward. If the 10-year US Treasury yield continues to increase quickly, that means borrowing costs are going to be much higher for all the companies, especially for high-growth tech companies. The discount rate to value growth stocks will also increase. There will likely be more large sell-off of high-growth tech stocks because many investors will continue to sell their high-growth tech stocks to switch to other investments that will be less impacted by high inflation risk or less impacted by rising treasury yield. Here is JD's second major risk. Chinese regulators are cracking down on anti-competitive behaviors, and there will be more restrictions on fintech companies going forward. As of now, Chinese regulators are investigating Alibaba's anti-competitive behaviors, such as 二选一, meaning that as a merchant you have to choose one between the two. Let's say if you're working for Alibaba, you're only allowed to work for one e-commerce platform instead of working at the same time with other e-commerce platform. As of now, the Chinese regulators are targeting the largest tech companies with the largest market shares. For example, Alibaba, Tencent, and Baidu in China. All of these have the largest market shares. JD may get targeted next because JD has the second largest e-commerce market share in China. It's very hard to predict this. The third major risk is this: Chinese financial regulators are restricting fintech companies' micro-lending business and its growth going forward. For example, Ant Group's IPO was suspended in last November. Now all fintech companies in China need to apply for licenses, just like a traditional bank. They all need to have enough capital reserve, and they all need to follow many very strict rules, such as establishing a financial holding company. This is from the South China Morning Post. A new rule requires online lenders to fund at least 30% of any loan they extend with banks. They must also put up 5 billion yuan in registered capital to offer online loans across provincial borders. The size of the loans are capped at 300,000 yuan for individuals, or the third of their average annual income for the last 3 years, whichever is lower. JD also runs a fintech business called JD Digits, which is similar to Alibaba's Ant Group or Jack Ma's Ant Group. JD Digits had to restructure. Now it's called JD Technology. Recently, JD Digits combined with JD Cloud and JD's AI business, so its fintech business will not be the primary business going forward in JD Technology. So all this means is that JD's fintech business can no longer grow its micro-lending business aggressively like before. Now I want to talk about JD's intrinsic value calculation so we can compare JD's intrinsic value as a whole company as well as its intrinsic value per share compared with JD's stock price. So what exactly is the intrinsic value? Intrinsic value is defined as the discounted present value of its future cash flow. I want to show you my intrinsic value calculation here. This spreadsheet shows you how I calculate JD's intrinsic value per share. There are 3 key assumptions I'm making in this intrinsic value calculation. The first key assumption is that we're using JD's future operating cash flow instead of JD's free cash flow because JD is still a growth company and JD is not a mature company. JD is still investing a lot of capital in new businesses such as JD Logistics, JD Technology, and JD's online marketplace. If a company is very mature with very low growth rate, it makes sense to use the free cash flow because the company has to return most of its capital to shareholders through either share buybacks or dividends. Most growth company has to reinvest most of its money or capital into its business so it will have higher revenue, higher new net profit, and higher cash flows going forward. So it makes sense for us to use JD's operating cash flow instead of using its free cash flow. The second assumption I'm making is that JD's operating cash flow will grow approximately between 10% to 28% each year for the next 5 years. In comparison, JD's operating cash flow grew at a compound annual growth rate, CAGR, of 28% between 2015 and 2020. The third key assumption I'm making is that we're using a 15.2 multiple to cash flow to calculate JD's terminal value at the end of year 5. This 15.2 multiple is from Morningstar. The discount rate we're using is 8.5% WACC from Finbox. I want to show you my intrinsic value calculator right here. If you look at this spreadsheet right here, I've made 3 scenarios. Worst case scenario, normal case scenario, and best case scenario. So each scenario has its own growth rate. Under the worst case scenario, we're using an expected average growth rate 10% each year over the next 5 years. If we discount all these cash flows to the present day using a discount rate of 8.5%, then the present value of future cash flow should be 860 billion RMB or 132 billion US dollars. This is actually the exact same 132 billion US dollar market cap as of March 19. And if we divide this intrinsic value by the shares outstanding, 1.55 billion, then the intrinsic value per share will be $85 per share, which is exactly the same as the current stock price as of March 19, 2021. Now, under the normal case scenario, we're using an average growth rate of 15% each year over the next 5 years. Then we discount all this future cash flow to the present day. Then JD's interest value will be at 1.051 trillion RMB or 162 billion US dollars. And if we divide this by 1.55 billion shares outstanding, JD's interest value will be at $104 per share. Under the best case scenario, we're using an average growth rate of 28% each year over the next 5 years. Then we discount all this future cash flow back to the present day. JD's interest value as a whole company will be at 1.721 trillion RMB. And if we convert that to US dollars, JD's interest value as a whole company will be at 264 billion US dollars, compared with JD's market cap of 132 billion as of March 19th. If we divide this by 1.55 billion shares outstanding, then JD's interest value share will be at $171 per share, compared with JD's stock price of $85 per share as of March 19th. Here is another assumption I'm making. I'm giving the worst case scenario a probability of 50%, the normal case scenario a probability of 40%, and the best case scenario of 10%. Personally, I believe that the normal case scenario is more realistic. The best case scenario is too optimistic, and the worst case scenario is probably more realistic too. If we multiply all these probabilities by the intrinsic value, then we can estimate that JD's intrinsic value as a whole company will be approximately 157 billion, compared with its current market cap of 132 billion. And if we divide this by 1.55 billion shares outstanding, we can estimate that JD's current intrinsic value per share will be approximately $101 per share, compared with its current stock price of $85 per share as of March 19, 2021. All this means that JD stock is slightly undervalued right now based on my estimates. Here are the key takeaways. I invested in JD stock 3 months ago before making this video, representing about 1% of my stock portfolio. Because I like JD's long-term growth prospects, I like JD's e-commerce business as well as its logistics network, which I believe is JD's biggest competitive advantage. I am planning to hold JD stock for many years, just like I have been holding my Amazon stock for at least 4 years. My short-term price target for JD is 157 billion market cap or $101 per share, and my long-term price target for JD is 265 billion market cap or $171 per share. All of these estimates and analysis are only my opinions based on my research. You have to do your own research and make sure to do your own due diligence. If you like this video, hit the like button, subscribe, and turn on the notification button. I will continue to make many great stock analysis and market commentary videos every week that will help you become a great investor. Thank you for watching. This is Victor from the Intelligent Investor channel, and I will see you in my next video.